Who do you think has a lower stress level? Somebody who's trying to earn percent, or somebody has their money that's not even tied to the stock market? Oh man, look how much money I'm saving in taxes. I'm saving $6,000 a year next to that fool who's doing infinite banking. Who's getting the last laugh? I'll tell you, one thing I try to hit home when I'm explaining infinite banking is that if you're doing this correctly, we should be able to build more assets or more wealth outside the policy than we do inside.
Guys, welcome to the Infinite Wealth YouTube channel. We're excited that you guys found us, and we're even more excited to be sharing this content with you. This content is going to be excellent. This is some of the most requested information that we get, and so I'm excited to be sharing it with you. Anthony, what about you?
I'm excited as well because we've talked a lot about, in theory, pros and cons of IRAs, 401ks, and infinite banking, but that was just in theory. Here, we're actually going to crunch some numbers and really do the math, which, as you know, as a recovering CPA, I'm a big fan of justifying with logic and numbers what it is we're doing. So I'm looking forward to today. Absolutely.
And then, guys, to let you know, this content is specific or more of a follow-up to one of the podcasts that we just did that's out there. Anthony, tell them the title. I forget what it is.
Can infinite banking replace your 401k?
Perfect, guys. So if you have a chance, you guys are out there driving around, go listen to that first, and then this will be a great supplement to that. But Anthony, let's get started. Let's dive into this.
Yeah, and real quick about that podcast, we spent some good time more pros and cons, right? But now we're talking numbers. So this makes great. If you want to get that podcast, you're on YouTube, you can click this link up here. But let's get into it, Cameron. Can infinite banking replace your 401k? And I think we need to define some terms. Right, is what of our benchmarks? Cameron, what would you say is the number one reason people set up a 401k?
Number one, easy, retirement income.
Yeah, exactly. We got to put some money away now so we can live the lifestyle we want later. So if the goal is cash flow in retirement, that should be our benchmark. So that's what we're going to compare today is if we put some money aside with infinite banking, how much income in retirement will we have? And then we're going to compare it. Well, all right, if we put that same amount of money into a 401k, what do we need to earn every single year to produce the same amount of income? So Cameron, why don't you do the fun part, talking about more of the benchmark with infinite banking.
All right, guys, we're looking at the policy that we put together, and nothing special here. What we did is we put together a policy. You can see we've got a 40-year-old male, preferred non-tobacco. He's putting in $20,000 a year, starting at the age of 40, all the way out to the age of 70. At age 70, he's got $1.3 million in cash value. And at that point, he can take $92,000 a year off in retirement income all the way out to age 90. So for 20 years, he can take $92,000 a year out.
Cameron, what's the tax rate on that $92,000 that you're taking out every year?
Tax rate would be 0.
Okay. Key thing to remember, because taxes are going to play a key part of this. So what the next question is, all right, if we put $20,000 a year into an infinite banking design policy, and we're not really talking too much about infinite banking here right now, but I do want to say that the design on infinite banking is very different than more of your traditional whole life. You're going to have more cash value, but less death benefit. Okay, but so here's what the question is: if we have $20,000 a year, we put that into our 401k. How much do we need to return to equal to be able to pull out $92,000 a year? So let's get into it. Cam, but before we go any further, we should define some terms of some. we're kind of lumping in a 401k, same thing as an IRA or a SEP or a 403b or whatever the retirement plan you have that's tax deferred, meaning we put in $1, we get a tax deduction on that dollar, but then when we pull it out, it's going to be taxable. Now, I know that there are after-tax 401ks or Roth IRAs. We're not going to focus on those for this in this example, and the reason being is because most people have more of that traditional or that tax deferred. Okay, and another assumption. So we're going to lump in all of these IRAs, 401ks. I'm just calling them all a 401k for simplicity. And another assumption we're making is that we're currently in the 25% tax bracket. Okay. So what we're going to do is we're going to put 20 grand away for 30 years. But as we're talking in regards to the tax deductions, if we put money into an infinite banking policy, that's after tax dollars. Okay, and money we put in the 401k is going to be pre-tax. So we're getting a tax deduction during our working years. So the way we're going to account for that is we're going to put 20 grand into the policy, and then in the 401k, we're going to put the 20 grand plus the tax savings. So what's the tax savings? Well, at 20,000, and we're going to use the assumption we're in the 25% tax bracket. So I'm going to take 75% of that. So what that means is to be fair, we're not going to put 20 grand in here. We're going to put $26,000 a year in here. So the question is, to be able to pull out that $92,000 that we can with infinite banking, what balance do we need to be able to safely take out $92,000 a year, which is a huge question. Fortunately, the industry has tried to solve that, and you may have heard of it as called the 4% rule, meaning you can safely take out 4% of your assets to ensure you're never going to run out of money. Now, this is not an earnings rate. This is a withdrawal rate, meaning if you have $1 million in there, you could safely withdraw 40,000. The problem is now people are having some concerns with the volatility in the market. Particularly, we had an extended period of low interest rates. So Forbes wrote an article, does a 401k still work in retirement? And they've talked about why this could be a recipe for a disaster. Bigger Pockets did a podcast literally a week ago discussing the same thing. Now, Bigger Pockets, if you haven't heard of, they're a great resource for real estate investors. If that's something you're looking into, I would definitely follow Bigger Pockets. Then USA Today, 4% rule about how much to spend each year of retirement no longer works from the creator of the 4% rule. Right? And so what it says in here, their research recommends doing a 3.3% withdrawal rate. Okay, so we're going to put somewhere, we're going to use 3.5. Okay, so what that means is if we want $92,000 in retirement, and we're only going to take 3.5% of our balance, that means 92,348 divided by 0.035. Okay, so that means we need to grow this balance not to 800, but to 2.6 million. So let's see, how much do we need to earn every single year to turn this 800 into 2.6? So let's see, 5%, not enough.
That ain't gonna cut it.
6%, we're getting there. 7%, I would say we're there. Okay, I know I'm a recovering CPA, but I'm taking my pocket protector off, and I'm not going to have this be to the exact penny. We're going to do some rounding. Cameron, be honest. What do you think? How realistic is it that someone could earn 7% every single year for 30 years in their 401k?
I think it's very unlikely.
I would agree with you. I will say it's possible.
Yeah.
And I think with most people listening to this, are probably expect even higher. But really, you got to dive a little deeper into the truth. Okay. But 7%, okay. I think it's obtainable, is what I would say. Okay. But if we have this money in a 401k, Cameron, is Wall Street, are they a non-for-profit entity?
No, they want to get paid.
They want to get paid. There are a lot of fees in the 401k, and so we're going to try to account for that. And what we went is, this is unbiased, and they said 401k fees can range between 0.2% and 5%. Now, what I think is interesting, a lot of people feel that there's the 401k has a small amount of fees. A lot of those fees are hidden.
Mm-hmm.
I tell you, I was a CFO for a chain of restaurants, and when we started implement the 401k plan, it was expensive to get started. I mean, you got to pay to get the plan. There's an audit every year, a lot of expenses, and that first year fees were over 20 grand. We're like, man, we want to help out our employees, but we're a small company. We don't have the 20 grand. They're like, don't worry about it. What they did is they just hid that 20 grand, those fees in the mutual funds and in the fee structure, which I even tried to find because I knew that they were there and I couldn't find them. Okay.
Mm.
But what we're going to use here is, let's just go in the middle and say 2.5%. Because don't forget, there's also fees in the mutual fund. There's costs for them and marketing and so forth. But so with those fees at 2.5, now we're down to 1.6. So we need to earn a little more. So let's go to 8, not enough. 9, getting there. 10, a little bit more. So let's just do 9.25, or we could round to 10. Okay. Now, Cameron, how realistic do you think someone could earn almost 10% every single year?
Do you want to increase your returns and lower your taxes? Well, that's exactly what the infinite banking concept can do. This is a game changer, and we can show you how it works.
Book your free call with us and learn how to build wealth the smart way. Stop procrastinating. Go schedule a call now. The link is in the show notes.
Now, Cameron, how realistic do you think someone could earn almost 10% every single year?
Last time I said very, now I'm going to say extremely unlikely.
Okay. All right. Get it. I get it. And I think you're right. But, one other thing I want to go over that we're not taking into account, if we look at that policy, Cameron, that you just had, the death benefit on day one, $1 million.
Mm.
Right? When at age 70, death benefits doubled. It's $2 million. One of the great things about whole life, that death benefit increases. What I'm going to do is somewhere in the middle. So I took 1.5 million. And if you wanted 1.5 million for a 30-year term, 3,200 a year. Okay. So what we're going to do is, this is going to be a negative 3,207. Okay. Now we need no problem. We just got to earn a little bit more inside our 401k. So 10, we're going to be at 10.25. Cameron, how realistic do you think you can earn 10.25 every single year for 30 years?
Not a chance.
Okay. I don't want to sound like that guy on the news, but wait, there's more. Or not the news, but the infomercial.
Yeah, Ron Popeil.
Yeah. One thing we did not take into account is that 94 grand that we're taking out of the policy, Cameron, what's the tax rate on that?
0.
Okay. We take 94 grand, or I'm sorry, it's 92 grand out of a 401k. What's the tax rate on that?
Whatever they're taxed at, earned income.
Exactly. So let's take a look, because we've all heard the message that we're going to be in a lower tax bracket when we retire. So let's look at what the tax brackets currently are. And right now, if you're married and you wanted to take out 92 grand, you're going to be real close in the 22% tax bracket. Okay. So you got to take out more. So we can't take out. So we need to net 92,348, and to take that out, we're going to need more than 96,000 to be able to net 92. So we're going to be in the 25% tax bracket again. Because again, if you live in, I'm not including the state income tax. Also, we're not including you have any other income. Maybe you're working a job, Social Security, or maybe you have another rental property. You have other sources of taxable income that's only going to increase it. But if we use the 25% tax bracket, let's see. 92,348 divide by 0.75. Okay, we don't need 92, we need 123. We need $30,000 more to produce that amount of income. Now, we're definitely in the 22% tax bracket. And you know what? If you're single, you're going to be well into the 24, not including state income tax. So what our new barometer is, it's not the 2.6. We need 123 and 0. Divide that by our withdrawal rate at 3.5. Okay. We just need 3.5 million. All right. Wall Street will take care of us. Now let's see what we need to earn every year. 1% it probably might be more realistic, but 11%, nope. 12%, right there. Now, Cameron, you thought it was unlikely to earn 7% every year. What about almost double? What's the likelihood of you earning 12%?
This is not happening.
No, it's not happening. And, I think this is a good point, that there's a lot more to it than just everybody's focusing on getting those tax deductions today.
Mm-hmm.
Speaking of taxes, so let's look at some math. Who paid more in tax? Now we look at for infinite banking. What we did is that, we were putting in 20 grand the policy, 26 into the 401k. That 6,600 a year is what that tax savings was. And we had the working years of 30 years. So we paid a total tax of about $200,000. But if you're with the 401k, that tax, instead of pulling out the 92, we needed 124. That's $31,000 a year. Now, again, we only went to 90, so it's only 20 years. But they paid $623,000. They paid 3 times as much in taxes. And Cameron, what's one of the biggest benefits people believe they have by contributing to 401k?
They have a tax deferment, or if they're in retirement, they believe they'll be in a lower tax bracket.
Yeah, a lot of them think, oh man, look how much money I'm saving in taxes. Mm-hmm. I'm saving $6 grand a year next to that fool who's doing infinite banking. who's getting the last laugh? Now these people are paying more in taxes, and this is also under the assumption taxes stay the way that they are. I mean, who knows? I don't think they're going to go down, or maybe down, but they're going to go up. But the bottom line here, I think, is that you are, with doing the 401k, you have to earn a lot of money every year. You have to have a high return. Also, that myth of that you're saving taxes just ain't true.
Yeah. Well, that was depressing.
Cam, and a couple other things. That we haven't even talked about is some intangibles here. Who do you think has a lower stress level? Somebody who's trying to earn 12%, or somebody has their money that's not even tied to the stock market?
I know who's got less stress. It's the IVC practitioner that's not subject to the volatility of the market.
Yeah. Now, I know there's this saying, oh, well, we're not going to need death benefit once we stop working. The people that say that are still working. Right? When we talk to people that aren't working, the legacy goals change. And also just even where we showed you the difference in the taxes for being single and married. Right? If you're married, but then one spouse passes, now you're in a much higher tax bracket. That death benefit is already paid for. Right? That is permanent death benefit. Here's the biggest thing, Cam. This is not infinite banking.
Well said.
The only thing you talked about was a whole life illustration designed for infinite banking. Right? So, Cam, this is a good segue. Why don't you kind of show us what are the impacts of incorporating infinite banking in addition to what we've already established in the policy?
I'd be happy to. I'll add this before I dive in there is I'm glad you mentioned it. And I'm glad we're covering this today is because I was in a meeting with somebody the other day. They called in and wanted to talk. And one of the first things out of their mouth was they wanted us to share an illustration with them. And this is the conversation I had with them was, man, listen, if you're just comparing or making decisions based on an illustration, you're missing the point. Mm-hmm. Right? If you just put money into a policy, that is the absolute bare minimum that you could be doing at this point. And so the conversation I had with him revolved around, hey, we're going to create cash value. What are we going to go do with it? And we came up with some hypotheticals. And so that's what I'm going to do with you guys right now is I'm going to use the illustration that we created, and I'm going to show you how you can take control over your finances moving forward. So let's get started here.
Let's see it.
All right, guys. So here's the policy that we're starting with. Nothing special, but I want to show you this because I want you to be able to see that all we did is I copied and pasted this illustration over into one of the calculators that we use. So we still have our 40-year-old preferred $20,000 a year going in all the way up to age 70. We got $1.3 million in cash value, $92,000 of income. Really, the metric that we're going to be looking at here in the next little bit is just kind of this buildup to this 1.3 million is how do we increase that so that we can supplement or increase this retirement income. So let's set this aside. And I've already loaded those numbers, 20,000 a year going into our policy, and we end up with $1.3 million in cash value in this case. And so now, again, the conversation is, hey, what do we do with this? What can we do with cash value? Faso knows the answer to this, but we can do anything we want. One of the conversations that we have with clients is that the recommendations we're going to have for you is based upon somebody's experience or skill set. And so the example I'm going to build here with us is we're just going to go make it an example very basic. We're going to go buy a rental property. The rental properties that I'm going to use or assume in this case is going to be roughly around these numbers here. Sorry. Go buy $100,000 rental property. We're going to need $20,000 to $25,000 for the down payment. I'm going to use $25,000. There's going to be a cost of about $5,000 for closing costs. So the assumption that we're going to use is $25,000 down payment, and then we're going to finance $80,000. Fast, does that sound fair enough? Is those all right numbers?
Yep.
Yeah. I'll share this with you, this example. If
Well,
we're going to go,
Cam, I got to imagine there's people on here being, I can't buy a house for $100,000.
good question. That is actually one of the thoughts I had years ago when I first got kind of started looking down this avenue. But guys, we've done many, many podcast interviews with a handful of turnkey providers. There's lots of rental properties that are out there being provided and offered by turnkey providers in the Midwest, Birmingham, Little Rock, Memphis, many other markets that range in the price from $100,000 to $150,000. So set that aside, and if that's a concern of yours, send us an email and we'll put you in touch, one with the podcast interviews that we did, and or we'll put you in touch with some of the turnkey providers. Thanks for bringing that up, Faso. I'm bringing this over just to show you guys some of the numbers I'm going to be using. If we're going to finance $80,000, I assume that our interest rate is going to be around 6.5% over a 30-year time frame. Our mortgage payment is going to be about $500. So that'll come into play here in just a little bit. But I want you guys to know where I'm getting the numbers from. So I'll set that aside. All right. So we've got funding a policy, $20,000 a year. Here's our cash value column. This is our gross cash value column. So you won't see these numbers change at all as I build this example. This is going to be net cash value numbers. This is what's going to change based upon how much money we're borrowing against the policy versus how much we're paying back. So Anthony, if we need $25,000 to purchase our first rental property, what's the first year that we can do that?
Be year 4? No, 3.
Yep, I was going to say you're close. Year 4, we got 58,000. Year 3, we've got 37,000. So I'd be comfortable recommending to a client that, hey, in year 3, we can go buy our first rental property. So we're going to use $25,000. We're going to take a loan against our cash value, $25,000. We're going to do that in the first year. We'll do that one time, and we're going to get that $25,000 paid back over a 15-year time frame. So does that sound fair?
Yeah.
Okay. Here's what's interesting is when we're borrowing against our cash value is the insurance company is going to charge us an interest rate. Right now, the insurance company's charging 5.3%. And so one of the assumptions I made here is that the rental property, the investment that we're buying in this example, is going to cash flow equal to what we're being charged. So these two numbers are the same. The reality of that is that's not the case, right? If I'm going to borrow against my policies, I'm going to be looking for a greater return than what I'm paying. But again, we're keeping everything very basic here, okay? So what you can see here is that we took out $25,000 loan in year 3 over 15 years. We have this loan paid back, so you can see that that loan goes to 0 in year 16. What I want you to see is that we started with $1.3 million in cash value, and we bought our first rental property, and we let the cash flow from that pay itself back, pay the lien back, and we ended up with how much, Anthony?
1.3.
1.3 million, right? Perfect. So there's nothing that's real special that's going on. But let's compare this. When we just did IBC, we had 1.3 million. We used the cash value to go acquire one cash flowing asset, a rental property in this case. And we still have the 1.3 million in cash value.
Mm-hmm.
But we also have $500 a month in cash flow from that rental property.
Now, so that was driven because the mortgage is paid off?
That's driven because the mortgage is paid off. Okay. And one point that we should make is what year was this mortgage paid off, Anthony?
Year 15, after 15 years?
Year 15, right? So we're just using the $500,000 a month that's coming back. All right, so the point being here is that we've got 1.3 million in cash value when we do nothing. Guys, if we go and we leverage our cash value to go acquire one cash flowing asset, not only going to still have our 1.3 million, but we're also going to have $500 a month of cash flow from a rental property and 30 years later, 26, 27, whatever it is, we're going to assume that we're going to have that house about paid off, and it's going to appreciate in value over time. So we estimated that's going to be about $250,000. Is that fair?
So that you just made an assumption of appreciation over 30 years, that 100 grand. Perfect.
I did. Yep. So it took 100,000, 3% over 30 years is about 242, give or take. We're going to assume 250,000. Is that fair?
Fair.
Perfect. All right. So now we're going to go do the same thing, right? Anthony likes to tell clients, if the first one was successful, we're going to go rinse and repeat. So now what we're going to do is we're going to take a look at this net cash value column, and when's the next year that we have enough to buy our second rental property?
The following year, right?
It is, yeah. You can see right here in year 4, we've got 35,000. And so we're going to build, right, in another loan, year 4. We're going to take another $25,000 loan against our cash value. The same metrics, it's going to get paid off over a 15-year time frame. Interest rate on what we're earning and paying is going to be the same. So our cash value will even out at the end. And now if we do that, not only do we have, hang on. We've got 1.3 million in cash value like we did previously, but now we are cash flowing $1,000 a month extra in retirement, and we have equity of around $500,000 at retirement. Fast, so safe to assume we've done this twice. Now we're just going to extend this example, right?
Yeah.
All right, perfect.
Yeah.
So now we're going to do number 3, and at 3 you can see that our end of the time frame balance is still not changing. We still end up with 1.3 million. We've got our third rental property, and at the end of this time frame, now we've got $1,500 a month of cash flow, and now we've got $750,000 of equity in our rental portfolio. And if we extend this one more time, now we've got 4 rentals, $2,000 a month extra cash flow in retirement. We've got $1 million in equity, and wait, there's more. All right, so we're building on this example, guys. If we take a look at this, a point I want to make here is in year 7, we've got $48,567 of cash value. We are about $1,500 just shy of being able to not purchase one, but being able to purchase 2 rental properties. Mm-hmm. So if you could stick with me, I'm going to make an assumption that we've got $1,500 in cash and that we can go buy 2. And so what we're going to do is in year 7, we're going to take a loan against our cash value of 48 and come out of pocket for 15. But now we're going to buy 2 rental properties. And if we scroll down to the bottom of our time frame of our timeline, we can see that we still have $1.3 million of cash value. And we now have 6 rental properties, and these are cash flowing an additional $3,000 a month, $36,000 for the year, and we've got equity of over $1.5 million in our rental portfolio. So now how are we doing in comparison to the 401k?
The what? Who cares?
Yeah.
Is what I would say.
The message that I would want somebody to see is don't get caught up on the numbers. The numbers are irrelevant. Look at the process here and look at the way that we've been able to take control over our finances instead of outsourcing it to somebody else, right? When we take control, we're the ones that are going to control how much money we're going to have in cash value and in cash flow at the end of the day.
So Cameron, am I seeing this right? We're still going to have the 1.3 million in our policy. Okay. Yep. We're still taking the $92,000 out a year, income tax free. Okay. And we have 1.5 million in equity outside the policy.
We do. Yep.
I'll tell you, one thing I try to hit home when I'm explaining infinite banking is that if you're doing this correctly, we should be able to build more assets or more wealth outside the policy than we do inside. And Cameron, you did a great job doing the math to support that. Also, you know what, your equity, you had the assumption of the 3% of inflation or appreciation, did you account for inflation or increasing rents during this entire time?
Did not, no.
Okay, so you're being very conservative doing that. Plus, it would be difficult to calculate it. But for one, that can give you that extra $1,500 that you needed in that 1 year to buy 2 properties. Okay, but also, because I tell you, to me, one of my key concerns long term is the cost of inflation. And you can have money in your policy knowing you're going to get that 92 tax free, but by leveraging against it, buying real assets that will appreciate with inflation, and also so will their cash flow. And to me, I think a key point is whether you buy these properties or not, you're going to have 1.3 million in cash value.
Mm-hmm.
But we didn't take any more. We really doubled our net worth without extending any more dollars. We just, with infinite banking, kind of one of the common advantages, we say we have our money working in multiple places. You have your money in your policy continuing to grow, and we have the ability to leverage against it and to put it into other assets. So if somebody has a whole life policy and they're not using it, you're losing a huge amount of opportunities here. And so this is just one of the many reasons, the advantages of using infinite banking.
Anthony, you made a comment a minute ago that we've got 1.5 million in equity and we've got 1.3 million dollars in cash value, that we actually have more outside of our policy than we have inside of it. And to be honest, if you look at that screen again, we're just getting started. If you look at this example, we're literally just getting started. This individual, or this example, shows 6 loans in the first 7 years, and this is a 30-year example, right? So we've got, 23 years where we just sat on the cash and we didn't do anything. How much better would this example be if we continued to kind of cycle that money through and acquire assets for the entirety of this time frame? So thought I'd mention that.
Cameron, so every year, if I know in some instances we can buy 2 homes in a year, but either way, every year, one of the 30-year mortgages are being paid off.
Mm-hmm.
Which means every year you're getting a raise in retirement.
Well said. Yeah.
I would say is if I guess let's go back to, did we answer the question, Cam?
Great point. Faso, if you could maybe summarize the 401k example for us real quick.
What I'd say, to produce the same amount of cash flow in retirement using a 401k compared to a whole life illustration, you can do that. You just simply have to earn 12% every year for 30 years. That's it.
Piece of cake.
I don't think that's possible. I mean, Dave Ramsey we'll say it can, but I've yet to seen it. But again, in summary, that's not infinite banking. That's just the power of a high cash value designed whole life policy. And Cameron, as you implemented, well, we have this great policy. We have that ability to put our dollars in multiple places, and we can use it to buy assets. You used a great example of real estate, but do we have to use this for real estate, Cam?
No.
You can use it, just like you mentioned earlier, you can use this for anything. You know, one of the downsides of the 401k is that we're limited on your investment options. With infinite banking, we don't have that government behind our back. You can invest in whatever you want. And I hope we've proven that infinite banking can replace your 401k without a doubt. And if that's something you want to learn more about, what we would suggest you start learning, and a great place to start would hop on a discovery call. You talk to Cameron and or I, kind of see, is this a good fit for you or not? Are we a good fit for you? And then we can talk about the best next steps. Because set up the policy is phase one, but then we also help people implement that cash value to multiply their returns. So the link for that will be in the show notes, as well as for our podcast where we talked about the pros and cons. Hopefully this provided some value on, can infinite banking replace your 401k? Any final comments, Cam?
No, well done on the 401k example, Faso. Again, glad we got this content out there. This is going to be tremendous for everybody. Hope you guys enjoyed it.
Go make it a fantastic day.
Take care.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.